Australia's second-largest property trust, Stockland, made a $241 million takeover offer for retirement village operator Avum over the weekend, an offer which has been firmly refused at this stage. Avum stock has soared 42% today, suggesting that the market expects a higher offer at some point. But while retirement villages may be a growth area, they're also very complicated assets. Joining me now to unpack the situation is Andrew Parsons, Managing Director of Resolution Capital. Andrew Parsons, welcome to Lateline Business.
Thank you, Tiki.
Is this a good move for Stockland?
Look, I think it's sensible. They've been building a presence in the retirement business over the last couple of years. It's very unusual to be able to come across a portfolio of assets in the sector of any scale. They've obviously built an entry stake there a couple of, probably about 12, 18 months ago. And it means that, as I say, they can get a critical mass of assets in one fell swoop.
And what about $1.50 a share?
Well, look, it's one of those asset classes, time will tell. I think it's probably on the cheap side of the equation. Maybe Stockland's come in a little bit opportunistically in terms of price. But because of the nature of the assets, as I say, we won't know for several years just how strong the cash flows will be from this particular acquisition.
Now, tell me about the nature of these assets, because they're actually quite difficult to model and to understand, aren't they?
Yeah, it's not a traditional form of real estate where you derive a rental income stream in a certain fashion. Basically, you purchase or develop the retirement village. You receive ongoing fees. In fact, they're deferred for quite a few years, and then that's subject to a myriad of different contract clauses in terms of some are based on end price, some are based on start price. So just getting to the bottom of what the cash flow is a very difficult thing for the retirement business.
Is this a particularly Australian thing?
It is. It does seem to be very unusual when you look at retirement businesses around the world. Most are a traditional rental model. Because of cultural, perhaps, idiosyncrasies, we've seen a model develop here which is quite complex. In fact, I'd say overly complex, but it is what it is. And so,
but that's presumably because we all want to own our own homes.
There is. I think that was probably the greatest justification for why people have gone into this. People want to feel that they own their real estate, that they can't be removed. Whereas when you're renting, obviously you're concerned that the landlord will terminate the lease and remove you as an occupant of the retirement village.
And yet you don't really own them, do you?
Well, again, you're absolutely right again. I mean, it's hard to work out what, in fact, the title is. It's not clear. It's almost like the inhabitant lends the developer money. And then at the end of the day, you sort of square it up when you then on-sell it to the next party. So it's very unclear what the obligations are. Some you're required to repay the inhabitant of the retirement village. Others, there's no such obligation. So it's a very difficult model to come to grips with.
So not being able to understand this, or making it, if analysts find it quite difficult to understand, does that actually help the company that owns the asset or not?
Well, again, I mean, ultimately they're hoping that's the case because of the subjective natures and some of the assumptions made to come up with a valuation. But ultimately, they've got to get their assumptions right. Otherwise, they will have paid too much. But it's fair to say when there is uncertainty, usually the market discounts or a purchaser should discount. So usually you can pick up these sort of assets at relatively good prices if you're a patient long-term investor.
And as a funder yourself, are you attracted to this sort of investment?
Look, it's hard not to be enticed by the demographics. There's obviously some very strong drivers in terms of ageing population. So it is a very attractive asset class, but you do have to do a fair bit of soul-searching and head-scratching, trying to come up to speed in terms of when the cash flow does, in fact, to come to fruition.
As you mentioned, Stockland did pick up a chunk of Avum just around or after the financial crisis hit. It also picked up a chunk of GPT and FKP. It's cashed up. Will it go for the others?
The market obviously is something that is ongoing debate in the market at the moment. GPT, it's looking more and more like Matthew will probably try to extricate himself from that investment. He has made soundings of late that he's only really interested in the retail asset. So it'd be hard to see that he'd try to put together a bid for the entire vehicle when he's only interested in a component of the overall vehicle. So I'd suggest that that's not a long-term position that Matthew's interested in, but Matthew could do the unexpected, and maybe he's playing mind games with the market. In terms of the FKP position, again, he's made himself pretty clear that he's after the retirement business. So again, let's see if he can work out a deal to extract those particular assets.
And what about the listed real estate market in general? How do you see that panning out at the moment?
Well, I think it's fair to say that after an enormous amount of mistakes by management over the last couple of years. They've done a lot of damage to the reputation of the industry, and generally that's a good time to look at an industry after it's been through something as tumultuous as it has. Particularly,
these are strategic mistakes, are they? Or?
Strategic mistakes, capital management mistakes, acquisitions, going into markets they should never have gone into. Largely that's been cleaned up, so it's a much cleaner structure, streamlined management, far more disciplined management. But we'd like to see a little bit more contrition on part of some of the management that we don't believe have learnt their lessons. But nevertheless, generally speaking, the market is obviously a little bit burnt, and that creates opportunity. So we think that generally speaking, with our economic profile, with yields as they are, and not an enormous amount of construction going on, real estate investment is not a bad asset class in this country at this point in time.
And indeed, we see some offshore investors quite interested too, don't we?
Absolutely. Singaporeans have been making some very interesting acquisitions here of late. Just over the weekend, there was a Canadian group that has swapped an Australian portfolio of office buildings from one hand to another, in effect, but a very interesting price. And it's showing that some of the local real estate prices look relatively attractive, particularly for the offshore buyers, given, as I say, the economic profile of Australia at this point in time.
And very briefly, when it comes back to those retirement assets, do you think they're assets that are going to grow?
Look, at the end of the day, the demographics are hard to avoid in terms of the ageing population. So there's not an enormous amount of development within the retirement industry. It does seem that there's more and more demand. So I think that, generally speaking, it's not a bad asset class if you can make the right calls about the cash flows at the end of the day.
Andrew Parsons, thank you very much for joining us this evening.
Thank you.